Morning, everyone. Hope you all had a great 4th of July. Glad you could join us here. We're an hour later than we usually are, so hopefully our coffee is still kicking in. We can give you a nice little office hours here. We're gonna go ahead and let a couple more people join as we make the group live here. So we already got about half the people ready. Oh, we even already have a hand raised. I don't know if that was intentional, but good to see that you're here. Well, guys, one of the things that people have been asking about is our 5-year performance. So we're definitely going to get into that maybe a little bit later once we have everyone on the call. Let the last few people trickle in here.
When you say performance, it's usually people that are just prospective clients for the most part.
I think Dave and Daniel can answer that better than I can.
Yeah, so I got it from a prospective client. So I figured it, I can talk about how I responded, but I'd be interested to hear kind of how you guys would respond to a question like that.
Okay, we'll get to that.
Still waiting on our last couple people here.
Okay.
We got a couple questions coming in through when people registered, so that's good to have a few to start with. But if you guys have any more questions, there's that Q&A button at the bottom. We'll be checking on that. We don't have any questions just yet. One kind of housekeeping question for, I believe it was one of our clients that asked this, was actually about, the fee changes at Schwab and how we're going to handle maybe making those changes in accounts. Dave, I know you've been kind of dealing with that lately, and Ryan, you too. Does one of you want to take that?
Yeah, for sure. I can talk about it. So really, in the fee changes more specific to advisory firms that have a deal with Charles Schwab called an asset-based pricing agreement. And so historically, the way things worked with Schwab is, as far as how they charge our clients, is there's really two different options. There's the first option, which I think people are more familiar with, which is called transaction-based pricing. And the way that works is anytime you place a trade, you pay a transaction fee. And that has changed over the years. It's come down. And now for ETFs, exchange traded funds, and individual stocks, there's actually no transaction charge. And for mutual funds for our firm, it's $20 per trade. And that has come down quite a bit, but obviously substantially higher than the free trades for individual stocks and exchange traded funds. Well, one of the nice things, historically speaking, was they had an alternative to that called asset-based pricing, where instead of paying transaction charges, you could pay a percentage of the account balance, and then there would be no transaction fees. And so that made sense. It was really a great deal for really small accounts. So, for us, it was 0.15% was Schwab's asset-based pricing fee. Well, if you're paying 0.15% of a $1,000 or $2,000 account, we're talking about, a handful of dollars per year. So that was a great deal. And so that's what we would do is we would look at which of those options is cheaper and then set each account just with whatever option was going to be the cheapest based on kind of estimates for how many trades we placed throughout the year and then also the size of the account. Well, Schwab recently changed their asset-based pricing agreement to also include a minimum fee of $10 per month. And so that's relatively high for small accounts. So as I said earlier, we only use the asset-based pricing for small accounts because we do very little trading in client accounts just because of our investment philosophy being buy and hold, passive investing. And with that minimum fee, it was basically made it so that under no circumstances would the asset-based pricing agreement or arrangement be the most cost-effective arrangement. So what we did instead of that is we're moving those smaller accounts to transaction-based pricing, and then we're going to utilize in the smaller accounts exchange traded funds as opposed to mutual funds. So that way we can still avoid actual transaction charges in those small accounts when we're placing trades and still kind of accomplish the same thing. So the exchange traded funds we use are primarily through Vanguard. There's a Schwab mutual fund that trades for free. So you end up in pretty much the same place. It's just that for those smaller accounts, it doesn't make sense to pay, $20 for, even if you place 1 or 2 trades per year, that can eat away at the returns. And it just doesn't make sense to continue using those mutual funds. So that's the workaround. It's really not a huge change. It's really only a change for those smaller accounts. But it is something that I think gets a little bit convoluted and confused clients a little bit. So that's why we sent out the letter in advance to our clients, just notifying them that, any of these smaller accounts are going to be seeing some changes.
Well, Dave, I think that's a great explanation. We might have to pull a snippet of that recording to, have your explanation for everyone to see all the time. Another thing that we got a question about was someone saw a headline, and Dad, this might even been your column headline, that people born in 1960 might have a reduced Social Security benefit because of what's going on in the economy. And they just kind of asked if you could explain that and whether that's the type of thing that we need to plan for in our financial plans.
Well, I mean, it's built into the financial plan. It's just something we've probably never talked about. This is an odd occurrence. So in the formula, when we get our Social Security check, it looks at your best 35 years. And what they end up doing is at age 60, they look at the average wages of that year versus from the very beginning of time. So it's kind of like, here's the present value, here's the future value. What's the discount rate, or the rate of inflation is really what they're calculating. And when you have wages go down, well, there's a lot of estimates. Average wage base could be down 10 to 15% because of the self-inflicted economic decline. That basically says, wow, this is the worst year in decades to turn 60 in 2020. And so it just has an impact where it might permanently reduce Social Security for some people 8, 9, 10%. So it's just in that average wage formula that has the inflation factor. In other words, it's just going backwards and adjusting all your wages to that, using that inflation rate to get your average index monthly earnings. And, it's something I really never paid much attention to because it was usually a non-issue until I realized this year, well, wait a minute, average wages are going to be quite a bit lower. I turned 60 last year. So for me, I will get the highest Social Security check that's available at full retirement age because I paid in at the maximum rate for a long time. So for someone like me, it really would have had a pretty significant dollar impact. But when you consider about half the people in the U.S., for half of them, Social Security represents the dominant portion of their retirement income. You're talking about a pretty significant event. There's some talk that maybe Congress might go in and make an adjustment because they recognize it was a self-inflicted wound, but I don't think anybody can count on that. So that's what that's all about. It's just an unfortunate year to turn 60. I can't think of any of our clients off the top of my head that turned 60 this year, but I certainly think we must have 1 or 2.
So then that would be something that would be reflected on future Social Security statements for their benefit estimate, correct? So then,
correct.
I think one of their questions is, how do we adjust our plans for that? It's,
right.
Well, we're going to update your Social Security benefit estimate just based on your estimate that's provided on your statement. And that should be, going forward, that should reflect any impact of this year's wages being down.
I think it also probably puts emphasis on the ways to combat it. It's no direct way, but it may force a person to delay Social Security even further than they might have wanted to, or maybe they work an extra year or 2 to replace some of their lower earnings 30 or 32 or 35 years ago, even on the indexed inflation basis, to offset some of that. So for most people, most of our clients, it's not going to be a material issue. But for 50, maybe 2/3 of the people, where it's such a dominant part of their income stream, it's a potential problem. Darn COVID.
Well, actually, that kind of gives us a transition. Speaking of government benefits impacted by COVID, someone had a question about the phase outs for the $1,200 stimulus check. So I just want to run through those again real quick. For a single person, you get the maximum amount up to $75,000 of income. After that, it gets reduced by $50 for every $1,000 of income. So it completely phases out by $99,000 for a single person. For married filing jointly households, the limits are double. So you have 150,000, you get the max up to that amount of income, and then it completely phases out by 198. So I just wanted to explain that real quick to answer that question. And then if you guys are ready, we can move on to the investment side of things.
Sure.
So I guess the first one is, you guys have gotten a couple questions about what's your 5-year performance. And there's been a lot of thinking about that lately. And you guys could probably explain a little bit more about why that is. Does one of you want to take that?
Well, Dave, you had the fresh letter, and then you guys can weigh in on it too. I'm too grouchy to answer those kind of questions by email. If a prospective client asked me that question, I probably wouldn't give the best answer to at least preserve the opportunity to take that person on as a client. But Dave and I spent quite a bit of time talking about it. Go ahead, Dave.
Yeah, so I'll just kind of share what I said, just generally speaking. And one was, I said, I think a better question is, should you really be making investment decisions based on 5-year performance? In other words, it's like, is that really even a relevant question? Because what are you going to do with that information? I think I said this a little more nicely in my email, but that's kind of the gist is, I just showed them and kind of explained, look, 5-year performance, even though 5 years sounds like a long time, there's so much randomness to it. And it tells you nothing about the future. And actually, one of the things that I shared with them was this chart from Dimensional Fund Advisors that showed, if you look at mutual funds, and I can actually try to pull this up real quickly.
Yeah, feel free to do that.
Can you guys see my screen?
Yes.
So this was a study done by Dimensional Fund Advisors, but it's been repeated time and again by multiple different places and researchers. And basically what they looked at is they said, if you look again, this is at mutual funds, at the top performing funds. So you just sort them from best performing to worst performing funds. And these are US based mutual funds. And then they said, well, what if we were just to pick the top 25% of performers based on the past 5 years? How do those do over the next 5 years? Well, it turns out only about 21% of them actually outperform their benchmark in the next 5 years. So even if you're picking investments or financial advisors based on the past 5 years and you're picking quote unquote the best ones or the ones with the best past performance, that tells you basically nothing about the future. If you look specifically at mutual funds, past funds that outperform don't continue to outperform in the future. And so that's just, it's one of those things, it's a standard disclosure that you hear so often, and I think people almost tune it out. But it's a disclosure. Past performance is no indication of future results. It's a disclosure for a reason, because it's true. And so I just like to remind clients of that fact and just basically say, I wouldn't want you choosing us or any other advisor based on 5-year performance numbers. Because if our 5-year performance numbers looked great relative to whatever you were going to compare it to, maybe it's the S&P 500 index, I don't want you to make a decision on that basis, because the next 5 years we could underperform because international does worse or value does worse or something like that. But we're going to be we're going to have different performance than these benchmarks. And then if you chose us because of our past performance and you thought we were going to be, outperformers, you're going to fire us over that next 5 years for that same reason. And then vice versa, if performance looks bad, that's just going to be backward looking, and it tells you nothing about the future. It's just one of those things that it really is not the right question to ask, but it is so common. And I said, look, I think, I can relate to why people ask this question, because one, they don't know better. So they don't know that past performance really doesn't tell you much about the future. And two, I think the financial industry kind of reinforces this focus on outperformance and beating benchmarks and how are you performing relative to other advisors, as if it tells you something meaningful, and it really doesn't. But with that said, I'm just curious to hear what you guys think and kind of how you would respond, or if you have any other kind of thoughts.
Yeah. I think it's just like you say, Dave, it's the conditioning that the financial media and some financial advisors or folks that purport themselves to be financial advisors have reinforced. And you see entire industries built on pumping out data that I think someone who is not trained in finance would say, well, they've given me the 6 month, the 1 year, the 3 year, the 5 year, the 10 year, the 15-year data and their performance, this must be of value. This must be something that is worthwhile for me to understand and know, because there's information in this data that can allow me or help me make a decision about what I should invest in or where I should move my money to. So it's really no fault of any investor that they look at this information and say, well, tell me why I should go with you versus the next guy if your data isn't as good. Well, unfortunately, as we've talked about here and has been researched in quite a bit of detail, there is no information that can be meaningfully given that will tell you about the future performance of those funds. And it's great that you had that chart on the ready, Dave, because I think for me, it also helps reinforce like the hard numbers of it. It's real. You can't just say that. You have to back these kinds of things up and show people, almost like a hit to the head. This is the reality of the situation, regardless of how maybe your brother-in-law tells you they're doing in their performance, or their sister-in-law, or whoever it might be you're talking to that week. Unfortunately, it doesn't hold up, and you have to go back to the data. And the data is quite clear, and it's evidence to the contrary of what, unfortunately, the common feeling is that the performance data matters looking forward. So I like you, Dave, I feel the pain of the investor trying to discern this information. And Paul Sr. is me being the younger advisor, looking up to you as the veteran for decades. I have a little more softness for the question because I don't feel so bad. Whereas you, I'm sure, have answered that question, hundreds, if not thousands of times in your life. You say, oh my gosh, it's the same question. Year after year, decade after decade. I can't believe we as humans haven't learned yet.
Well, probably the first 5 or more years of my career, I thought it was useful as well.
Sure.
Until you realize that it's just this untreated sewage that comes, just a tsunami of it from the financial media that's always trying to take our eyes off. Remember, the financial media wants to extract your long-term historical performance or historical perspective, because if they can do that, then you need to tune into their show every minute of every hour of every day. So I come from the position that it's the financial media that's trying to extract our historical perspective. So I've probably gotten grouchy about it. I've told the guys that the minute somebody starts in the first meeting obsessing about what fees are, what's your performance, I instantly tell myself internally, fortunately at this point, this is a disqualified potential client. But you guys have to realize, if other people but our clients that have been with us a long time heard that response, they'd say, oh, their performance must not be good.
Right.
And if you looked at the last 5 years or even 10 years, a globally diversified portfolio looks relatively terrible compared to one asset class, the Standard & Poor's 500 index, that we've all been trained that that's the important index to beat, or that it's important to beat anything. And to me, it's just not about conquering the markets. Is irrelevant to investment success. Conquering the wanting to believe that past performance is an indication of future results, that current events, somehow we should react to those things. It's the recognition that there are no facts about the future. That's the most difficult impediment to long-term financial success, unfortunately. But I can honestly state, and any of my clients that have been with me for 2 or 3 decades will tell you it's true. Those decades where our performance was considerably better than the Standard & Poor's 500 index for a period of a good number of years. Any prospective clients, I never talked about our performance being better. Is there probably in the archives a time or two I might have, probably when I was younger and less sensible. So again, it's our job then to make sure we don't let a prospective client, or a current client for that matter, frame things in a way that's not useful, that doesn't move the ball forward. It's a constant training of our clients. And it's probably really strange to hear a financial advisor say, investment returns are irrelevant. it's only investor behavior that matters. And at the end of the day, I think it's the people that keep calm. I'll give you a real life example. I just wrote about it for my column that will come in this Sunday's News Gazette. It's about human nature, of course. It's what I seem to always talk about. But when you get real life examples, empirical data from the likes of Fidelity Investments, one of the biggest investment firms in the world, and they look to see what all their clients did with their stock portfolios between some point in February and some point in May. And then they did it by ages, et cetera, and they sliced and diced it. But the point, since we're in the retirement planning business, the thing that stuck out to me is 1/3 of their clients at Fidelity Investments sold all of their investments pretty close to the bottom. If you look at that time frame they were looking at, only to miss the best 50 days ever in U.S. history after the fact. So that tells me that investment performance doesn't matter. It's how investors behave. And that's only going to be successful in the backdrop of a real financial plan, where it shifts the complete conversation from what's my performance been this block of time to how does what's been happening impact me in my life and in my plan, essentially. And that's unfortunately my long-winded way of saying I hate the question of what's your performance. And I usually try to disqualify the prospective client on the front end. And I say that we've all done a really good job. I'm just going to say it because rarely does performance come up when we're speaking with our clients that have been with us a long time.
But I think one of the things that can be difficult, like you mentioned earlier, is the way that people frame their performance decisions, even if they don't matter. They kind of anchor to the S&P 500, which of course, when it's doing really well, everything else looks pretty bad. And that's just one of the things that I think we always have to emphasize is that we own different areas of the market. You know, we own emerging markets, we own international developed markets, we own, you know, even within the US, we own smaller companies and we own value companies. And when any one of those doesn't do so great, Dave, I'm kind of looking at you because you brought up this question about the value premium. You know, people kind of wonder, like, why are we tilting to those other asset classes when the S&P 500 seems just such like a no-brainer?
Or for that matter, look at the NASDAQ. It seems to be in a parabolic incline that reminds me a little bit of the end of 1999 when the blue chips kind of had all peaked much earlier, many months earlier than the NASDAQ, and it just kept going up and up and up. And this is because the professional traders concentrate they look at these things, they see the V chart of the NASDAQ 100 in technology stocks, and they all jump in, and you can see it.
And Paul, I like how, you know, you brought up, look, we own different stuff. And that's one thing I had just written down as another point, just back on the, 5-year performance thing was, I told him just straight up, I was like, I don't want this to come across as me ducking your question. I just said, I think the one thing I can tell you is just a little bit about our investment philosophy, which is, look, we're using passively managed index-like funds. They're basically designed to capture the returns of certain asset classes. And from a big picture standpoint, we're basically owning the entire global stock market with a little extra emphasis on smaller companies and value companies and companies with high profitability. That's because research has shown those types of companies have higher expected returns over really long time frames. And so I said, look, your returns are basically going to mimic the global stock market fairly closely, but it's going to have a little more emphasis on the U.S. because we have a home bias, which just means we invest more in the U.S. than like the natural representation in the global stock market. And the returns are basically going to be what they're going to be. We're not picking individual stocks or trying to time the market, and we're not using funds that are picking stocks or trying to time the market. So you don't have to worry about, hey, is this person just an unskilled investor? Are they, or if they had good performance, have they lost their touch, or are they making bad bets? We're not doing any of that. We're using these passive funds. The returns basically are going to be very similar to the global stock market. So whatever they are, they are. It's not, again, it's not like it's a representation of investment skill or lack of investment skill. And then the other thing I brought up too, and this is the last thing, and then we can move on to value, is I do think it's pretty common practice. I saw this a lot when we worked at Dimensional Fund Advisors, was you'd have financial advisors that would screen a Morningstar database. And a Morningstar is just basically a database of mutual fund information, and you can just screen it to sort by, 10 or 15-year investment performance. Then they build a portfolio of the best performers over the last 10 or 15 years. Then they show these clients, hey, look at this portfolio I created. It's great. The past performance is amazing. Like, okay, that's fine, but you didn't actually own those funds during that time frame, and it still tells you nothing about the future. And so I mentioned that in my email to this prospect is, look, that practice is fairly common, hopefully becoming less and less common because it's incredibly misleading.
Well,
so those are just a couple important things I think for people to be aware of, is that it's easy for someone to put together a portfolio that looks great, back tested, but it doesn't mean they actually were invested that way over that whole time frame. And it still doesn't tell you anything about the future, even if you're looking at 10 or 15-year periods.
I was just going to say, in some ways, Morningstar was probably the most detrimental creation and event for investors, because when they came out with their star ratings, which is just a look back, right? Who got to the top? They never bothered to tell investors, oh, by the way, this is probably a perverse indicator, and you're probably better off buying lower ranked star funds. They've kind of amended their ways and come more in line with reality. But I think the real focus, just from an historical perspective, if anybody's interested, is when Morningstar came out, everybody, why own a 4-star fund when you can own a 5-star fund? And David just showed you the results of that is really a perverse indicator.
And
it's really hard to admit. It's really hard for people to admit that there are no facts about the future, and we don't know what the future holds. It's unknowable. That's probably the single hardest thing for investors to recognize and deal with, is that there are no facts about the future.
And I think what we have to do is ask the real question: do our portfolios get our clients where they need to be, even if bad returns do show up? And that's really what we're doing for people. But sometimes it is easy to get lost in just the return portions and not see the big picture. So that's why simulation is so important. I sound like Dad now talking about why simulation is so important, but it is. We need to make sure to build a portfolio.
Simulation is very important.
Yes. So.
Well, and like you said, it's like investment returns are ultimately a means to an end. Investment returns are just really, it's money or growth of your money, and money is a means to an end. It's used for other purposes. The goal for the vast majority of people is not just to accumulate as much money as possible. It's to live the best life possible and to use their money to do things and to maybe give money away or whatever. But like you said, the returns are a means to an end. It's not, beating a benchmark is not a financial goal. Funding your children or grandchildren's college education is a financial goal. Funding your lifestyle throughout retirement is a financial goal. You can do those things whether or not you beat a benchmark, or you could outperform a benchmark, but still fail to do those things if your plan is inappropriate. So I think, like you said, people can lose sight of the big picture.
And I think you've always said to people, what's the alternative? So to get these higher returns, we already built a low cost, globally diversified portfolio. So we have that. So it's like, well, to get those higher returns, do you want us to time the market? Maybe, pick stocks. We know we can't do those two things. Well, it's like, then you got alternative solutions, which we know those usually end pretty poorly. And then we got the idea of, well, I guess you could go into bonds, but we know after taxes and inflation, you don't end up so hot. So it's, well, do you want to just take on more equity allocation, more stocks? Well, no, not necessarily. Well, then it looks like, you're kind of stuck where you're at, not in a bad type of stuck, but I mean, it's like you can only do so much. You need to build a low cost diversified portfolio that gets you to where you need to be in the future and where you want to be based off of the goals that you're trying to achieve throughout your life. And those are the things that really, really matter. And you need to build a portfolio that can reliably do it. But when you start to market time to get higher returns or pick stocks or do any of that stuff, that's where people get into really big trouble, because they lose sight of what's actually important.
thing is, you don't need to outperform anything to have a wonderful life and do everything you wanted to do. But if you go into strategies that have an 80% chance of underperforming, which active management does, that underperformance is very risky. So that's a risk that you don't have to take and you're not going to get compensated for. So it's pretty practical. What do you guys think of, just as an aside, I've seen probably 2 or 3 articles in a row saying the new 60-40 portfolio, which I'm referencing when I say 60-40, that's generally accepted at 60% of my money in stocks, 40% in bonds, is the new 75-25. And they're getting back to saying, well, since returns on 10-year treasuries are maybe 6 or 7/10 of a percent, CDs probably the same. In other words, if 40% of your portfolio is earning 1 or 2% as opposed to historically 4 or 5, that your expected return from that 60-40 portfolio is not going to deliver what it wants. So therefore, you need to trade out of some of your bonds and put more into stocks. I'm hitting, just so the listeners know, I'm hitting these guys with something that's not rehearsed. I'm just kind of, how does your brain spin on that?
I know from our side of things, we don't look at bonds as being a driving force of returns. So I'll speak strictly to kind of our mindset, not necessarily the broader investment world. But if our goal is bonds delivers stability generally, at least significantly relative to stocks, then we're not reaching for return in our bond funds. And we're putting our clients into an allocation, for example, 60% stocks, 40% bonds, with an expectation that it'll do fairly close to the expected returns with variability in the short term. And the goal would be is like, well, we reevaluate year after year, looking at where the stock market is at that time and how their goals are funded and their plan is funded and what percentage of probability of success they're at. And generally, I can't think of a particular client that I've worked with where we've had to move up in stock allocation because of poor returns. So the goal is really, what is the nature and the need of bonds? Well, for us, the nature and the need is stability and short-term liquidity. And we put that into play this year during COVID times as the stock portions and everyone's portfolios were down across the board. So you use that stability to start pulling out to allow and essentially buy yourself time for those stock positions to go back up. So that's our rationale for bond usage, and it's protection. It's definitely not the return side of things. That's my 2 cents.
And David, I think I shared with you, I might have shared with all of you guys, I'm always down here in my dungeon in the basement doing more and more simulation, trying to make more and more sense every day out of what the distribution of future outcomes might look like. I think I shared this with Dave. I went in and ran my own simulation and said, okay, for the next 3 years, if interest rates are around 1%, plus or minus 1% standard deviation, then the next 2 years, maybe up to 2%, which these are, from an historical perspective, that's really low. And then after 5 years, more normal for short-term, high-quality fixed income, somewhere around 4%, with a standard deviation of maybe 4%. A little more normal. So saying the first 5 years of, say, a 30-year retirement, I really expected that to have a pretty big impact. Because if 40 or 50% of your portfolio has half the expected return of what you would expect historically. And I don't know if that's the right way to do it. Maybe I should do that for longer. Maybe I should assume 10 years. For practical reasons, I'd be happy to get into them. I don't think interest rates will stay real low for real long. Had very little impact on most simulations that I did. So it turns out to me that it's not really having any real impact on the asset allocation decision.
Yeah, and I mean, you also have to realize that it's like, well, yeah, you could increase your equity allocation to 75%, but then your portfolio is going to fluctuate a lot more. So it's not like this cost-free thing that you just,
Right.
Oh, I guess I had a 60% stock portfolio, but bond returns are going to be lower. So I guess I'll just go up to 75.
Yeah.
That has big implications. I don't think that's something you should just kind of like thoughtlessly go into. I mean, a 75% stock portfolio is going to have much larger declines when the market's down. So I don't think you should just change based on that. Like Brian said, at the end of the day, everything should be based on a plan. There are different people out there in planning softwares that will project returns for different asset classes. So some of those, they project lower returns for bonds, and you can adjust, like you said, in your spreadsheet from a planning standpoint. But I don't think the right approach is necessarily to increase your stock allocation. I mean, maybe if you can handle it, but you need to make sure that you can handle that higher level of fluctuation.
Yeah, all these people are doing is saying, if this is the expected return of bonds now, and this is the expected returns of stocks, we just need more stocks.
Right.
But they're not then taking that expected return and running simulations to see if, as David said, you start moving up the fluctuation meter. Yeah, your expected return goes up, but you're less confident that you'll get that expected return. So more than people care to know about, probably.
Well, so I have a question for you. Like, why is the financial industry obsessed with the 60-40 portfolio to begin with? Like, why is that a thing? Is there a history?
I don't know. You would think that, who was the Markowitz, who was a Nobel Prize winner in finance, and someone asked him what he does, since he's one of the smartest people on the planet. He says, well, I use a 50-50 portfolio because half the time I'm mad I'm in stocks, and half the time I wish I had more. I don't know where it came from, other than if you look at most financial plans, well, even the 60-40 most of the time there's probably a 40 or 50% equity portfolio that you could easily substitute for it. So people I don't know, other than probably a lot of people these days don't want to have 50 or more percent of their money in bonds earning a couple of percent a year. But I don't know the answer to that. But, of course, it moved in the pension fund and endowment area right at the worst time, before the 2008, 2009 great market recession. There was more and more of the largest endowments and pension funds saying, well, we're moving to 70-30 instead of 60-40 at just the wrong time. So these things will move. I don't know, but again, if you ask most people, what should a retiree be? It'd be either 50-50 or 60-40. And I'm not sure that's not wrong, but there is no right answer. There's no one answer for millions of people.
Dave, I'll chime in what I think my answer is. And of course, I have no proof of any kind, but I think it kind of goes back to like investor psychology. We always think that we should do better than average, or we should always seek out higher returns. And if you take 50-50 portfolio, 50% stock, 50% bonds, you're dead center, obviously, in between your allocation of 100% stocks and 100% bonds. So 60-40 seems like a nice mental check to say, oh, I'm going to do better than the guy who's just average, and I'm going to take a little bit extra without betting the farm. That's kind of always been how I've thought about it. Like, the 60-40 seems to be glorified in financial news. Like, oh, 60-40, this is the allocation of your dreams. And some articles I've seen, is the 60-40 dead? Like, yeah, that is the most meaningless article column I've ever seen, rather. It's like, is it dead? Absolutely not. It's not dead. It's unique to each investor. Well, it's like, it's this panacea drug that you're like, here you go. Here's your 60-40 allocation. You're welcome. You're all cured now. It's silly to me, but that's my 2 cents.
Like so many things, it's kind of the rules of dumb. With all the thousands of hours I've done on simulating, if someone asked me, probably for someone who really is immune to fluctuation, in front of a 3-decade retirement, what's the ultimate allocation? I'd say the golden allocation is 80% stocks, 20% bonds. And that's based out of real simulation. And of course, simulation is not the truth. Simulation is just a model. If I was going to move one way or another, I would move that way. That's not advice. It's not what we push on people. Because I'm working on stuff now that's starting to suggest to me a different way of maybe thinking about these things, where you might actually start out in retirement at 20 or 25% equity, and you let the stock portion build. But that's another day. It's just something I'm working on, and I would think over the next year. clients will know if we're thinking about implementing those thoughts.
Guys, I can tell we kind of have trouble just talking about investments because we always sort of zoom out and view things as what does that really mean to your plan? But I don't want to run away from this question about value and why we overweight value stocks in particular, because that's one of the ways that we're different than the market and why our performance might be a little bit different.
For sure. Go ahead, Dave.
Okay. So, I mean, the short answer is there's a lot of research that's, it's been established at this point, it's peer reviewed, that value companies, and when I think of value companies, I think of it like a value in anything else. You're getting something that's still relatively high quality at a low price. And so the financial industry will measure value in different ways, but I think the one that intuitively makes sense to people is the price to earnings. So if you pay a low price for a certain amount of earnings, that might be considered a value company. Now, the funds we use actually use book value instead of earnings because it leads to lower turnover strategies, but you kind of get the concept. We're paying a low price for a certain amount of earnings or profits or book value or something like that. There's research that those types of value companies have higher expected returns. They've historically had substantially higher returns than what are called growth companies. And when you think of a growth company, you can think of a company like a Tesla or an Apple or something like that that's really popular. They tend to have a high price relative to their earnings. So that's, I mean, the main reason for it is, well, there's research showing that value companies have higher expected returns. And I did have some slides ready for this too, not to get too nerdy. But value companies are one of what we call dimensions of expected returns. It's things that explain the expected return of a stock. The other one is the size of the company and then how profitable it is. I'm going to jump forward real quickly though, and let's focus on this middle column. You'll hear it called relative price sometimes, and that's really just another way of saying value. And what you're seeing here, this is the return in this gray column, the return of value stocks in the US dating back to 1928. You can see the return was 12.41% compared to the return of growth stocks of 9.11%. So 3.3%, we call it a premium for owning value stocks. So that's the main reason for it. Now here's the issue. Just because on average value stocks do better, it doesn't mean they do better every single year. And so what this chart is showing is anytime there's a blue bar, it means value stocks did better than growth stocks. And if the bar is red, it means growth did better than value. Well, you can see there's a lot of years where growth did better than value, but on average, value does better than growth. And so recently, and this is why that question came up, you can see we're on quite a stretch where growth has been pretty much crushing value. And it's been over 10 years now where growth has been outperforming value. And so this person just asked, hey, just remind me again why we overweight value, because it seems like it's not working super well. And this person, he kind of gets it. And it wasn't like an attacking question. It was just wanting to understand. And so his follow-up question, when I kind of told him, look, there's a value premium, was, well, how long do you have to have in terms of time horizon to be confident that you'll actually earn a higher return in value stocks than growth stocks? And so I actually showed him this slide, which I'm just going to focus on this top right-hand corner. And what this is showing is rolling periods of different duration and how many of those periods value beat growth. So this is in all 1 year periods, value beat growth 60% of the time. For 5 year periods, it gets better. Value beats growth about 3/4 of the time. And then for 10 year periods, you see value beat growth about 83% of the time. So you can see the longer your time horizon gets, the higher the likelihood is that value will outperform growth. But there is never a guarantee that value will outperform growth. That's the risk that comes along with these returns. Even if you have a 20 or 30 year time horizon, there is no time horizon where you have an absolute guarantee you will be better off in value. But the odds are in your favor, which is why we choose to do this.
But Dave, nobody ever thinks when they see that, go back for a minute, when they see that 83%, people really struggle with probabilities. They see 83% and it's a sure thing. No, 17% of the time you're going to be sorry over a 10-year period. it's kind of like the last election. Hillary Clinton had a 70% to the Silver guy, Nate Silver, 535, I think, .com. And he wrote about how people just thought he absolutely blew it because he said Hillary had a 70% chance of winning. So to them, Hillary wins. How could the guy be so wrong? He's saying, I put in there was a 30% chance that Donald Trump could win. So probabilities are always difficult for people. When they see that 83%, it's like, count me in. Then the 17% shows up and it's like, well, I didn't know that could happen. Well, yeah, it says right there, 17% chance.
And that's why you don't put all your eggs in one basket, right? That's why we don't only own value stocks, even though research shows they have higher returns. Well, it's because sometimes they don't. We don't want to put all our money in value stocks. It's another reason why we don't put all our money in U.S. stocks or international, or, you saw on some of those slides, small companies have higher expected returns than large companies, but sometimes they don't. And that's why we want to own all of these things. We just put a little extra emphasis on those value companies, the smaller companies, and the highly profitable companies. And those premiums, the size premium, the value premium, the profitability premium, they don't move in perfect lockstep. There are periods where value does poorly, but size does really well, or profitability does really well, or vice versa. So it's really important to still own the entire global stock market and not get too carried away on any one theme, because no matter what, there's going to be times where a certain investment strategy or asset class is going to be performing poorly relative to others. There just inevitably will be, no matter what the strategy is. And so that's why you want to be diversified.
Okay.
And then, guys, we are on to our last question. So if any of our attendees have any more questions, go ahead and get them in now while we answer this last one. But this one, I think, hasn't gotten enough attention, or at least as much as it normally would. And that's, how will the election impact the market? Everyone always worries if their guy doesn't win, the market's going to tank. It's 50-50 as to what they're worried about. But people are worried about, what happens in an election year, and maybe if they should eventually just wait to retire or wait to invest until, I don't know, the dust settles.
It's probably fair to say half of our clients are worried the world's going to come to an end if Trump is reelected, and the half of them are, wondering is the end of the world if he is elected. So we probably have a pretty equal distribution. I don't know what your guys' thoughts are. I think the historical evidence is pretty good that it's not something that should drive any portfolio decisions.
What I hear running through my head, Paul, is what you've said, I think 2 times on this call already. There are no facts about the future. And I think a lot of times we try to put our own emotions and our own personal beliefs into what will happen because of any factor, this one being the election. But generally, when we have such a diverse and intricate global market, one impact of a presidential election is just one impact. It's not everything that's affecting all companies equally across the world. And I think most folks, they overemphasize what they think matters because of their personal beliefs.
It's a little bit of fear driven. It's emotion driven. One thing I'll say, with the NASDAQ at all-time new highs, which are basically high tech stocks when we say NASDAQ, kind of concentrated in that. But the S&P 500, not that far from, its all-time high. You'd have to say that with Joe Biden's being ahead of the polls, that Wall Street is not fearful of Joe Biden. So in some regards, everybody extrapolates, but taxes may get increased. They probably are, regardless of who comes in. That's one way to pay for these huge spendings. Inflation's another. That's why earlier I probably should have dropped a die marker that said I don't think we'll be in a period of short interest rates, because I don't think of low interest rates. I don't think we'll be in a period of really low inflation, nor really high inflation, but higher than people are used to. So it looks to me like Wall Street's not too uptight about a change in presidency. They're self-serving. They're only interested in how much money they can make. I don't think they care who's in, just so they can continue to. Well, sometimes I don't have a favorable view of Wall Street, so
I was going to say, don't go down that rabbit hole yet. We always try to stay apolitical on here. Well, I think
Oh,
one thing,
and I am apolitical. I'm just talking about Wall Street. They are truly apolitical to the extent that they don't care if they kill babies as long as Wall Street, gets what it wants. Oh, sorry.
My short answer
I've been
when
in the
people
basement too long.
my short answer when people ask me about the impact of the election or a certain person getting elected is that, if you just look historically, again, there's no facts about the future, but we can look just over, multiple decades. Investment returns have been strongly positive regardless of which political party holds um, office in the White House or even other political, offices. And I actually do have, this is my last slide. I prepared a few of these in advance. And I'll actually, for the people on this, I'd love to hear your feedback if you like having the slides that support, or if it's just kind of distracting and you'd rather have us
Or,
just kind of talk.
and if they do, or if they want them, there should be an easy link to where they can download them if they're client ready.
Exactly. But I'll go ahead and share this last one. I need to scroll down. But this is annualized returns during presidential terms. Let me zoom in here a little bit. And the red bars are for Republican presidents, and the blue bars are for Democratic presidents. And what you see is primarily, if it's to the right, it means that positive returns in this x-axis. And you can kind of see the percentages down there. You see almost all positive returns just because the market goes up more than it goes down, especially over 4-year periods. And so you can see, perfect example is, I like the recent ones. When Obama was elected, especially the first time around, I know a lot of people who tend to be more conservative and vote Republican were very concerned because they thought he was, very, you'd hear people throw around terms like he's a socialist and whatever. We obviously had very phenomenal returns over the next 8 years. The other half of our clients were really been out of shape when Trump got elected, and returns have been really strong since he got elected. Obviously, we had this downturn recently, but still, even from when he got elected to now, returns have been very positive. Then you see again, Clinton, great returns, obviously.
I would re-elect Clinton.
Bush and Reagan. So you can see there's no if this person gets elected, it's clear that it's not favorable for the stock market. Chances are, regardless of who gets elected, the stock market's going to have positive returns over the next 1, 3, 5, 4 years over their term. So staying on the sidelines or waiting to retire just until an election happens, it's not really like a worthwhile endeavor. And if anything, especially if you're keeping your money in cash on the sidelines, you're running the risk of missing out on returns. And again, that's not to say we couldn't have an election and then the market tanks. That's always a possibility. But it's always a possibility that the exact opposite happens, where someone gets elected and the market runs up. So like I think Brian kind of alluded to, at the end of the day, we don't know. There's no facts about the future. But trying to make investment decisions based on forecasts or forecasts of political outcomes tends to be a losing strategy.
Right, because you could be right about who's elected, make that forecast right, but wrong about the conclusion of what happens.
Yeah.
well,
That's what Daniel was just saying, because I know why Paul flinched. When I said kill babies, I was not referring politically about abortion. I was like literally going down and, killing babies.
all right.
Did I just make it worse?
Yeah, I don't know. On another note, I was gonna say that no matter who's in the White House, CEOs and the people working for these companies, they're gonna go, all right, maybe I think this person's crazy, or I don't like this policy or that policy, but guess what? We got to make sure we keep this business profitable, and we're gonna make a way to do it. And that's what they've done historically. And honestly, I have faith that the workers across this country and the people in charge of these big businesses and small businesses are going to end up making a profit. I mean, even us as a small business, no matter who's in the White House, we have to go, okay, well, maybe they changed this policy or that policy, but we still got to be profitable, and we're going to do it. And I feel like that's kind of the mentality in general.
I've always felt like that side of the ledger is always the true story. It's kind of like they wake up, like look at the other side and like, oh, here's the new rules. Okay, boom. They still have that incentive to provide the best return they can for their shareholders. So there's no reason to think that that has changed at all. I mean, I think we don't evolve that quickly.
Well, guys, that's it for the questions today. Does anyone have any final thoughts before we wrap up?
No, I mean, just if anybody would have told me, in February that we'd be where we are from both an economic and stock market standpoint, I wouldn't have believed them. And of course, everybody now is giving their opinions of what's coming. And I was like, well, we could use better information a few months ago, but it wasn't there because exactly none of them forecasted the fastest bear market in history, followed by the best 50 days in history. So I'm not about to start listening to them now. So I would suggest to all our clients, don't start listening to the pundits now. Except for us, we're pundits, but you should listen to us.
Well, on that note, yeah, we'll see you guys in a couple weeks. Thanks for being here. Thanks for all the great questions, and hope you guys have a great rest of your week. Take it easy.
All right.